Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, April 12, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. I've got a lot of stuff to go over tonight. The market, despite what it might look like from the outside looking in, it might look just like another up day in the market and everything's fine, and maybe so, but I have a lot of information that I've drawn out of the market today that I want to go over tonight. It's very interesting, and if you're a market follower like I am, it's very fascinating. Not only the way we unfolded today, the way we closed today, and what's coming tomorrow and into next week. So let's start with the daily chart. So obviously you can see on the daily chart, we have the important line, the horizontal line or resistance line that comes in at 266.75. We spiked through it a little bit today, but closed below that line. So today's high happens to be 267 even on the button. That's not an accident. That's not a coincidence. Markets tend to get drawn to, a lot of times will spike above or below even numbers, but even numbers like 267, for example, is an attractor to the markets. Now, what I'll say about the daily chart is, and this is extremely important, time is running out. We're at a very important inflection point in terms of time. Traders that have taken the Lazy E-mini Trader course understand what I'm looking at when I say time is running out. There's a very important time component that exists on the daily chart where tomorrow, and we'll get into tomorrow in a second because there's some important earnings tomorrow, and earnings will begin tomorrow. Earnings season begins tomorrow morning, and it's very important. Let's get back to time. Because we're at an inflection point of time, we could see a market reversal tomorrow. We could see a spike up and an intraday reversal. We could see the market float higher tomorrow, but reverse on Monday. Time doesn't have to happen tomorrow, or time doesn't have to be up or run out tomorrow. But what I'm saying is time is running out, and over the next 24 to 48 hours, it's critical, and we're likely to see a market reversal over the next trading day or two. I alluded to it last night. We appear to be trading up into the time zone that's very important, and therefore we have to be very aware that the market is prone to a reversal over the next trading day or two. And I'm going to get more into that and why that exists when I get down to a shorter time frame beneath the daily chart. I also want to stop and take an opportunity to thank everybody for the comments that you're leaving on the videos. I love the interaction. Keep the comments coming. I love to hear different perspectives of the market, and I'm happy to give you my perspective, even if it's not directly related to the market, but external events that do impact the market. I love all the comments. Keep them coming. Keep liking the videos. It's helpful. It continues to get the word out. And I know that a lot of you are sharing the videos. Please continue to share the videos with those that you care about that you think would find this information valuable and helpful. So I can't thank you enough for your interaction and participation. So let's wrap up the daily chart real quick. You can see here that we did find resistance at the 266.75. Can we trade higher? Yes. I mentioned before that earnings season begins officially tomorrow. How does it begin? We have JP Morgan, Citigroup, and Wells Fargo, and I believe a couple of other banks reporting earnings tomorrow, and then they're really going to get underway into next week and beyond. For several weeks in a row, earnings are going to come fast and furious. Those of you that trade the gaps with me, put your seatbelt on, because this is the time. It happens 4 times a year, and it usually lasts for about 6 to 8 weeks where the trades just come fast and furious. We certainly get gap trades almost each and every day, but to the magnitude that we're going to see them over the next several weeks, it's just a wonderful opportunity right in front of us. It's an opportunity to make money in these markets each and every day directly from the gap trades. So let's talk about a couple of possibilities as a result of if the market does go higher from the earnings, for example, the bank earnings. Let's say the market does go higher. You can see what the next very important level is for this market. So you have this breakdown candle where the market gapped down, and this gap down occurred on the 22nd of March. So that gap down occurred. It also coincides with the convergence of the 150 period moving averages. So I'll draw the line in again. So we have a very important level above us. It's actually quite a bit above us, but it is possible that we do get there if we get some kind of a spike on these earnings announcements in the morning. It's possible. We could get a spike and a reversal. We can get a spike and follow through. And on Friday, for example, the market can certainly trend higher and finish near the highs of the days up into these moving averages. If that happened, I would be looking for, and if it does happen, we'll obviously talk about it based on tomorrow night's video, but if it does happen like that, I wouldn't be surprised to see the market reverse into next week. So we could see higher prices tomorrow on the bank earnings. We could also see, and this is where I'm going to get into the hourly chart and also the 10-minute chart, we could see the market actually just trade down off of the earnings tomorrow. It is somewhat of a coin toss. We don't know exactly which way it's going to go. It's kind of like rolling the dice a little bit. I'm not in the guessing game. We're not in the business of guessing which way the market's going to react to the bank earnings tomorrow. We have to see the reaction, and that'll give us a lot more information on what we need to do in order to profit from this scenario going forward. So let's take a look at the hourly chart. What do we see on the hourly chart? Well, you can see here that the 266.75, the market came up into that level first thing in the morning, and we consolidated right underneath that level. We hit it a couple of times or came up short a couple of times, and you'll see that clearer on the 10-minute chart when I get over to that in a second. But then towards the end of the day, we made an attempt to break out and we failed. And that's interesting. It's interesting to me because the market had every opportunity to break out. We consolidated all day beneath that level. And when we did break out, we popped above that level. We got to the 267 area, and then we failed right at the end of the day. Now, even though the market was up decently today, so the spiders were up about 83 hundredths of a percent, or almost 1%. We'll call it almost 1%. The Dow was up 1.2%. The Nasdaq Composite was up about 1%. So across the board, it looks like a good, healthy up day from a bird's eye perspective. But this market, in my mind, had every opportunity and actually should have broken out to the upside, and it didn't, and we reversed down. Now, technically speaking, there's nothing wrong. This is still a bullish consolidation pattern, and we can still trade out of this tomorrow on the upside. And if the market wants to react positively to the bank earnings, that's going to be the catalyst, and this market, this consolidation pattern, will certainly release the energy to the upside, and then when I showed you on the daily chart, could play out trading up into that next important level on the into the moving averages and the next pivot high where it's the top of the breakdown candle from the gap. But I'm just a little suspicious that we traded down towards the end of the day. The market basically failed at the end of the day. Here's the 10-minute chart. So here's what happened today, and it's easier to look at it on the 10-minute chart because you can see exactly what happened. And by the way, there's something very interesting that happened, and it produced a really, really good trade. And anybody that's taken the course at Lazy E Mini Trader should have been able to identify this trade. So you can see early in the day, we made an attempt at that 266.75. Came up a couple of pennies short. The high was 266.67, so came up 8 cents short, and we pulled back a little bit, and we went back and forth for a little while, and we made this pivot low right here. So we make this pivot low, and then the market traded up for a very specific period of time, and this is where the course comes in. After the market traded up for a very specific period of time, we put in a signal of a trend change right after touching the 266.75, spiking through it by just a few pennies, and then you can see what happened. The market put in a nice reversal for about a half an hour, and where did we go? We went right into the bottom end of the opening range low from the day. What do I always say? Markets like to come back and retest former breakout and former breakdown areas. The market gapped up this morning, and we came back to test the breakout area from this morning, the opening range low. So what that tells me is that this market is trading very technically sound. Regardless of what you think the news is, whether it's Syria, whether it's Trump, whether it's a trade war, it doesn't make any difference. When you see things like this happen and the market trades to certain areas and reverses on a dime, that's the way the market is just trading technically sound. And then you can see here that we trended up for the remainder of the day until we spiked through the 266.75, and then we reversed in the last 20 minutes of the day to finish poorly on the day, and I think that has the possibility to be very telling. And unfortunately, we won't be able to tell until tomorrow morning after the bank earnings and after the market opens. We'll see if that was meaningful or not. But I am suspicious of the close today. Now, before we move on, I want to take a look at one more chart because I think there's something very important to reiterate about the spider chart or the S&P 500 chart. Here's a weekly chart. So we go from a short time frame, like a 10-minute chart, all the way to a weekly chart. Each candle represents 1 week of trading activity. And the reason I want to reiterate this and bring it to the forefront again is because this is, again, a bearish pattern on the weekly chart that's developing, or it's really developed already. So we have a down move, and we're consolidating in a bearish wedge formation. And the reason I want to bring this up is because certainly this market has an opportunity to trade higher, for example, into, let's say, the 20-week moving average that comes in right about 270. We can trade right up into that. We can trade higher. We can trade all the way to the top of this breakdown candle and still remain in this bearish wedge formation, which would still result in another or ensuing move to the downside. And that's the reason I wanted to take a bigger picture look at this market. When you go back to the daily chart, for example, remember where we started this. I said we could trade up into these moving averages. Where do these moving averages come? 269, 269 and a half, maybe even up to 270. What happens to be 270? 270 is filling the gap that was left open by the gap down on the 22nd of March that we just talked about that. You see how the numbers coincide with each other. If we did trade up into that area, let's say 269 or even 270, certainly the sentiment would be very bullish. There would be a lot of bullish discussion in the media. People would try to hop on board, try to play the momentum to the upside. And that's the way the market sucks in as many unassuming traders and investors to the bullish side before once again pulling the rug out or opening the trapdoor to the downside. I've seen this happen over and over and over again, which brings me to the last point I'll make on the spider chart, which is if we did see higher prices, for example, tomorrow, trading up into some of the areas just discussed, it doesn't take the downside off the table, and it doesn't change the fact that I still don't think this market has put in the type of low that we need to see, certainly down here at whether it's 250, 240 something, it doesn't make any difference. Somewhere down here is where I think the market will put in a more prolonged low that should be for a sustainable rally for several weeks to come, or even possibly longer. But in my book, that event has not taken place yet. Taking a look at the IWM, interestingly enough, was actually again a lagging index, up 0.6% today. And it's interesting, you can see where we went today. We spiked through the upsloping trend line that comes from the long-term chart. Let's go back and just refresh our memories of where that comes from. So this comes from all the way down in 2011, and you can see where we connect the pivot lows, and this is where the trend line comes from. We start here, and we connect this pivot low, and this pivot low right here, and the market draws in this trend line, and you can see how we hit this trend line and sold away from it at one point here, okay? And then we rode this trend line up, we broke above it, and then we failed, and now we're riding the bottom portion of this, or the underside of this trend line. So it's a monthly trend line, which means the only important closes as it relates to this trend line are the monthly closes. So we have a couple of weeks left in the month of April to where it'll be important where we close, whether it's above or below this trend line. But so far, We've spent 3 months, or I should say 2.5 months, when we failed. So we got below this trend line in February. We stayed below it in March, and we'll see where the month closes of April, above or below this trend line. It'll be very important to see. Why is it important? Because the IWM is my favorite market leading indicator on the up and the down side. Does anybody think it's a coincidence that we spiked above this trend line intraday but closed below this trend line today, and it was a laggard of an index today? The S&P was up more than the IWM. On an up day, you would like to see the IWM, or the Russell 2000 index, leading the market to the upside. That would be a sign of strength in the market. So I don't think we necessarily have that today. In fact, I know we don't have institutional participation today in this up day, and I'm going to tell you why. Look at the volume. The volume today was very minuscule. We only had 14 million shares traded in the IWM. The average volume is 27 million shares. This is a 90-day average take. And the IWM, the volume today was about half of the average daily volume. By the way, let's take a look at the spider volume. I neglected to talk about it before. The spider volume was 68 million shares against a 90-day average volume of 128 million shares. So again, roughly half the volume. If this market was breaking out to the upside and you had institutional participation, we would see more volume on the up days like today. Maybe we get one going forward, maybe we get one tomorrow, and that's fine. But that's not what we have today, and we have to go with what the market is telling us currently. Moving along to the transports. Now, we did have a nice, healthy, big up day in the transports, and it was on decent volume. We had about the average volume in the transports. Today was about 59, almost 60 million shares traded in the transports, and that's about right on the average volume or daily volume in the transports. Big up day. However, that doesn't change the fact that this is in a bearish pattern, okay? And we're just still inside the range that we've been in ever since we started this. So we up, down, up, down, up, down. So now we're in an up phase. Are we going to break out to the upside? Well, we don't know. That's not what happened. It didn't happen yet. Whether we do or we don't remains to be seen. However, we're still in this channel. So maybe we go to the top end of the channel. That's fine. What happens at the top end of the channel? The question is, do we break out of the top end of the channel or do we go back down? We're not going to guess. We're just going to wait for the market to give us the information when it gets there. Now tonight, I also want to talk again about the VIX because I'm finding something very, very interesting on the VIX. And again, those traders that have taken my course understand why this level is extremely, extremely important. Right now in the VIX, we're teetering on a price level where this bullish pattern can actually fail. It can break apart. The bullish pattern can be taken off the table, and they had every opportunity to send the VIX a little bit lower today, and they did not. So what I'm referring to is the low today, for example. Let me move the chart. The low today happens to be $18.16. A very important level in the VIX happens to be $18.12. So the low of this breakout candle is $18.12. Remember from before, I mentioned when we were talking about the 10-minute chart of the spider, markets love to, and I mention this all the time, markets love to come back and check in at or test former breakout and former breakdown areas. The VIX broke out to the upside from this last pattern that we had, or this consolidation area down here, okay? So we broke out to the upside and we've consolidated for a long time. But now the VIX has come back to check in at or test the lower portion or the low end of the breakout candle. If the market's going to break out to the upside, the VIX is going to go lower and it's going to take this bullish pattern off the table. These are very important things to understand and know when analyzing the market and trying to decipher what the next likely move is going to be. Right now, the VIX still has intact a bullish pattern. If the bullish pattern stays intact, that'll likely mean lower prices for stocks. If the bullish pattern is broken and taken off the table, that will mean higher prices for stocks. So it's important to look around at various different markets and understand what various different markets, what their patterns are telling us. I chuckle a little bit because I get so excited, and I obviously don't know anybody that gets more excited about red and green candles and the shape they make on these charts than I do, but I find it very fascinating, and it served me well over a long period of time analyzing the markets and the charts in the way I do. And frankly, that's why I put together the course, because I know it can serve other traders well in terms of understanding how I look at and view the technicals of these markets. Over in the gold market, you can see here that we put in another, it's just back and forth. So here is what can be termed as a reversal day in the gold market. From yesterday's big up day, we came into a very, very important resistance point, and today we reversed back down. So what this tells us is, obviously that was resistance. I don't see us going any higher anytime soon, meaning in the very short term. We may come back to test that same resistance point. However, today's activity in the gold market was very telling to me. It was a reversal from a very important resistance area, and that tells me that we probably have at least sideways to lower prices coming in the short run. And I've been saying this for a long time. It's been a very difficult market to try and trade. Gold has. I haven't tried to trade it. There hasn't been a clear, definitive picture, a clear, definitive pattern on the charts to really trade from in quite a long time. And it's been very, very challenging for anybody that trades in the gold market. So as far as I'm concerned, still leaving it alone. Crude, on the other hand, bullish. So while we may consolidate up here for a while, we got very, very overbought in a very short-term period of time. So in the last 3 or 4 trading days, we got to what I would call an extreme, very short-term overbought condition. But that's okay. This is bullish. This chart is telling us that crude oil wants to go higher. It's telling us higher prices are coming, even if we have to go sideways to eat some time off the clock, give the 20-period moving average a chance to move up in toward price as we get extended from home base. As you know, the market likes to come back to home base, so maybe price comes back a little bit. And for those of you that are new, home base is the 20-period moving average. The market never really likes to get too far extended from home base. So we got a little bit extended from home base recently. So if the market goes sideways for a while, home base will come up toward price, or maybe price comes down a little bit toward home base. But all in all, this is still a bullish chart, and it's telling us higher prices are coming. Those of you that have been around for a while know that my target in crude oil is around $73, $74 a barrel. I've been talking about that for at least 2 or 3 months. Even while the doubters were in here at $58 a barrel, I had still been saying $73, $74 a barrel is where I'm expecting crude oil to go. And if it does reach that price, based on how it gets there, and we'll see what happens when and if it does get there, that may provide a stone cold short in the crude oil market. And with that, folks, it's everything I wanted to and intended to discuss tonight. So I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.